Since its 2014 peak, China's industrial output has dropped by 4%. What happened? Millions of new homes now lie empty, turning bustling cities into ghost towns. The once economic giant now faces a crisis that could lead to its ultimate collapse in a matter of years or even months. This crisis is unfolding fast, threatening everything. What could be the cause? What is driving this crisis?
China and the United States have held talks for the first time since the Trump administration's imposition of heavy tariffs on Chinese goods. That's happened here in Geneva, Switzerland.
It all started in 2018. This was when the United States, under President Donald Trump's first term in office, launched a trade war targeting the Asian superpower. What began as modest and considerable trade tariffs quickly escalated into something that shook the very foundations of China's export-driven growth model. Initially, Trump imposed a baseline tariff of 25% on over $34 billion of Chinese goods imported into the United States. This was an early signal that the era of free and unfettered trade with China was coming to an end. Over the following months, those tariffs more than doubled, with an additional 10 to 25% added in subsequent tariffs. This move made certain Chinese imports subject to taxes well over 100%. The Chinese government retaliated by imposing 25% tariffs on 545 American goods as well. With a president like Donald Trump, trust the United States to respond with even more relentless measures. The impact of this move on most Americans was immediate and visible. For context, consider the iPhone, Apple's flagship product. Most components of these devices are manufactured right in China, and the new tariffs meant that the cost of making iPhones in China and importing them back into the U.S. would nearly double. Some industry experts at the time warned that, without changes, the retail price of a new iPhone could climb to $1,800 or even $2,000, more than double its pre-tariff price. But the story didn't end at Apple. Thousands of other products, ranging from clothes and furniture to electronics and machinery, became more expensive as these tariffs were passed on to consumers. The United States was aiming to make Chinese products less competitive in its market, with the hope that Beijing would be forced to alter its trade policies and currency practices. In response to the United States, China faced a tough choice. Its economy relies heavily on exports, especially to its largest single export market, the United States. However, shifting production overseas wasn't going to be quick or straightforward. While companies began moving their supply chains to countries like Vietnam, India, and Mexico, these alternatives could not match China's scale or efficiency overnight. The infrastructure, workforce, expertise, and manufacturing ecosystems that China has built over the decades were difficult to replicate. At the same time, the Chinese yuan has also been devalued against the dollar, making the situation more economically complex. Yuan depreciation may make exports more competitive in external markets and reverse the negative effect of tariffs. However, it may also amplify the fear of currency devaluation, which normally destabilizes investor confidence and raises the cost of settling foreign debt. Worse still, the emerging signs of a renewed EU-US trade alliance threaten to further isolate China. Negotiations between Washington and Brussels, which aim to eliminate or reduce tariffs between the two, would create a unified front against China's tariffs and restrict its capacity to access European markets. As the European Union accounts for nearly a third of China's exporting destinations, such a union between the two would severely restrict Beijing's global trade. For Beijing, this blow in the back seems to be coming from every corner. Its trade war, once geopolitically distant, has now escalated into a full-blown attack on the heart of the country's economic engine. Will China adapt, or will it collapse under this mounting pressure of tariffs and exchange exposure? Let's examine another sector of the Chinese economy that is contributing to this impending collapse. While tensions from global trade patterns are draining the strength from China's external markets, a crisis is also unfolding deep within China's borders, one that threatens to cripple the nation's financial system and social fabric. The Chinese property market has long been regarded as the pillar of the country's very rapid economic growth. The reason is that both domestic and foreign developers rely on their booming property sales, which power household wealth creation and infrastructure investment. However, beneath the surface, cracks have been forming for some time. China presently has between 65 and 80 million unoccupied housing units, or ghost cities, scattered in provinces such as Sichuan, Hebei, and Guangdong. These abandoned building towers and half-finished developments serve as a constant reminder of overdevelopment and miscalculation of capital resources. Among the biggest names in the crisis is the conglomerate Evergrande, which was once China's second-largest property developer. In 2021, Evergrande shocked the world when it defaulted on a $300 billion debt, the largest ever corporate default in history. This sent tension across global markets and sparked fears of a domino effect on the rest of the Chinese real estate sector. After Evergrande, other major companies like Country Garden and Kaiser also faced problems with rising debts, weak sales, and tougher rules on borrowing. In response, the Chinese government introduced the Three Red Lines policy to limit how much debt property developers could take on, aiming to control real estate speculation. These rules had serious effects. Many middle-class buyers who had put down payments on apartments that were not finished now faced delays or cancellations. In cities like Chengdu and Zhengzhou, some homeowners stopped paying their mortgages because they could not move into their homes. Local governments, which heavily rely on revenue from land sales, are experiencing a decline in income and worsening budget problems. The crisis has long converged with the post-COVID economic slowdown, during which China's domestic consumption weakened amid faltering industrial output. The reliance of municipal governments on property revenue created a questionable situation, and with property sales coming to a standstill, so did additional infrastructure spending and social programs. However, for China's middle class, the dream of ownership is slipping away, quietly draining their savings and inspiring social unrest. Against the backdrop of a somewhat tenuous financial safety net, these trends threaten to expose the extent of citizen trust in the state. The real estate bubble remains more than an economic problem. It is, in fact, a ticking time bomb. If it escalated into an outright one, the spillover would result in a banking crisis, with bad loans skyrocketing and credit markets freezing too. This would not only halt China's growth, but could even unleash a series of economic and social unrest. This leaves China in a delicate balancing act of trying to defuse the real estate crisis without triggering a collapse that could undermine years of progress. China's rise over the past 4 decades has been nothing short of extraordinary, driven largely by a relentless investment in factories, infrastructure, and technology. But that engine of growth is now revealing cracks that raise serious questions about how much longer this investment-led model can keep the country on its current path. For decades, China's strategy was clear: pour money into building everything. This resulted in the springing up of roads, bridges, airports, factories, and housing developments at a breathtaking pace. This rapid development also created jobs and demand across industries, powering China's GDP growth rates above 9%. Even after the 2008 global financial crisis. Yet now, that momentum is beginning to slow down very fast. Infrastructural projects that once seemed essential to growth are now increasingly viewed as overbuilt or unnecessary. This overcapacity means that new investments yield diminishing returns relatively quickly as well. Money invested in new construction does not generate the same economic boost it once did. To compound this, structural fatigue is the inevitable demographic time bomb. China's population is reportedly shrinking, with a birth rate that continues to fall well below the replacement level. According to the country's National Bureau of Statistics, the population dropped by 2 million in 2023 alone, its first decline in decades. The workforce is shrinking even faster, meaning fewer younger citizens are entering the job market to support the aging population and drive economic expansion. Youth unemployment, especially among college graduates, has been on the increase. Official data shows that in mid-2023, unemployment among those aged 16 to 24 hit a record high of over 21.3%. This means that many young Chinese are struggling to find jobs that match their level of education. This mismatch not only wastes talent, but also threatens the country's social stability. The Chinese government now faces another challenge in managing its capital flows. To prevent further financial crisis and maintain a tight hold on the economy, China maintains absolute control of its capital, which restricts the amount of money that can be taken out of the country. although it protects the currency in the short term. It also makes many foreign investments unappealing. Investors are reluctant if they cannot easily transfer their profits, especially during uncertain times. Indeed, foreign direct investment in China has also been shrinking. According to the United Nations Conference on Trade and Development, China's inflows of foreign investment dropped 8% in 2023. Several factors, including geopolitical tensions, trade restrictions, and a domestic crackdown on private companies, particularly in the tech sector, have spooked many investors. Over the past few years, regulations have become tighter with increased data control, as tech giants like Alibaba, Tencent, and Didi have faced huge fines and been forced to undergo restructuring. All these factors, overinvestment, demographic challenges, restrictive financial policies, and political tightening, combine to slow down China's economic engine. Growth projections, which once confidently sat above 6%, now move around 4%, according to the IMF, with some analysts predicting even lower numbers soon. Meanwhile, China's current economic challenges have been likened to an era of stagnation and deflation in Japan's recent history, which began in the 1990s. There appear to be some striking parallels between the histories of both countries, as well as signs that the situation in China could prove even worse than that of its neighbor. Japan's bubble economy of the 1980s was fueled by excessive real estate speculation and easy credit, much like China's current property boom and debt-driven growth. When Japan's asset bubble began to burst in the early 1990s, it ushered in a decade-long period of slow growth, deflationary pressures, and financial uncertainty. Despite numerous stimulus efforts by the government and international bodies, Japan's economy struggled to regain its initial speed. China now faces a similar type of risk as massive debt accumulated by state-owned enterprises and private developers continues to stress the financial system. Real estate bubbles in multiple cities with millions of unsold housing units threaten to implode property values. Additionally, deflation looms on the horizon as consumer demand weakens amid companies cutting back on investment. Several stimulus efforts, including infrastructure spending and monetary easing, are being implemented to mitigate the harsh reality. And while past decades always had stimulus propelling growth, today's efforts at stimulus will have declining returns. With the small budget stimulus of the current government combined with the size of the economy, every stimulus now has a lesser effect on the public and the economy itself. Additionally, the demographic pressure that Japan is facing is also affecting China with growing intensity. China's workforce is shrinking at a faster rate amid an aging population, adding pressure to social services and productivity. Unlike Japan's more homogeneous economy, China's size and global integration make its slowdown far more pronounced worldwide. The ripple effects of all that could go wrong with China would be severe. China remains a significant consumer of commodities, including oil, copper, and iron ore. A prolonged period of slow growth could significantly reduce demand, further drive down prices, and impact other commodity exporting countries, particularly in Latin America and Africa. Emerging markets that are dependent on Chinese trade and investment may face capital flight and renewed recession. Global supply chains would also be affected, as many industries rely on Chinese manufacturers and raw materials. Such disruptions could increase costs and heighten global inflationary pressures. China's economic path forward may be uncertain, and only time will tell what it might transform into. Whether China becomes the next Japan or something far worse, one thing is clear: the ripple effects won't be minimal, so stay alert. The world economy's next chapter is already being written. Thanks for watching. Please like the video, leave a comment, share, and subscribe to the channel to stay updated. See you in the next video.